4,100 gold, it could actually happen very quickly. I think it could happen within like a month or so. It could be a very explosive move. The weekly and monthly charts are really strong. So it's exciting. We're looking to potentially get long gold as a trade here that could last a week or two as a discretion, or sorry, a month or two going forward here. If we take a look at the price of silver, of where it could potentially go, it did have quite a bit of damage done, but it is still pointing to the upside target of about $40.70 or 80 cents. So it has some upside, and it might blast past that if we do get this surge of people moving into physical metals.
Silver isn't breaking out, but it's holding up. The market has clear support, even if momentum is lacking. Right now, it's a classic buy the dip setup. The metal continues to trade with a strong inverse correlation to the US dollar, which is under pressure amid growing economic and geopolitical risks. With a crowded calendar of data releases, rising policy uncertainty, and tariff threats making headlines, in that environment, precious metals are gaining attention, not just as hedges, but as serious allocations. Technical analyst Chris Vermeulen has been closely tracking silver's price structure. He notes that the market has suffered some short-term damage, especially in mining stocks, but remains bullish over the medium term. His upside target stands at $40.70 to $40.80. If physical demand spikes, he expects silver to overshoot its current price. But he's also clear, without clean breakouts in silver miners or junior gold names, it's still a cautious trade. The market's thin and reactive. Traders need to be selective. Gold, by contrast, is building real momentum. Physical demand is strong, and the mining sector is catching up. Large cap miners in the GDX ETF have already broken out, a move Vermeulen calls a significant signal. Historically, these breakouts come just before aggressive rallies in the metal itself. Big institutions are turning more bullish. JP Morgan is projecting $4,000 gold by 2026. Vermeulen thinks it will come faster, possibly within a month. He sees one of the strongest technical setups in years, fueled by collapsing yields, weakening fiat, and an increasingly unstable equity market. Jefferies analysts point to the gap between bullion and miner valuations. Gold equities are still priced as if the metal were trading at $2,500 per ounce. That kind of disconnect doesn't last. Once capital starts rotating into hard assets, the repricing could be fast and aggressive. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Take a look at these two charts. Now, the one on the left over here, this is the S&P 500 candlestick. Now, this is 2007. This is the peak when the S&P 500 topped out in 2007. We also have this yellow line, which is gold. Now, gold ripped higher and was outperforming. It was one of the number one assets at that given time, even though the stock market was pushing to all-time highs. And gold was giving us this huge warning sign that, hey, if gold is outperforming everything else, including the stock market, you better be aware there is some global fear. There's probably going to be a global financial reset. And that's what gold is really good for. Silver doesn't do it, miners don't do it, but physical gold pricing does. And what's interesting is here is after we saw it top out, the market went a little bit higher, and then the stock market started to sell off. And what happened with gold, if you follow that yellow line, that gold shot up 37% while the stock market fell 20%. And what's really interesting is, let me just show another asset class in here. If I just scroll back to just before the stock market topped, and we look at the dollar. This green line is the dollar index. Wow. Nobody wanted the dollar. It was the most hated currency out there. Well, fast forward to today, stock market put in a top. Now we've popped up to this nominal little high, just like we saw back over here in 2008. Gold is one of the top performing asset classes long-term right now. It has been on fire. And I believe we're about to see this go off a cliff, the stock market, and gold is going to become that defensive play. And if we look at the chart of gold, which I had up here initially, the chart of gold has had a series of bull flags and patterns. And this last big rally over the past more so 10 months is a bull flag pattern. This bull flag pattern is a very accurate way to get a gauge of where the next upside move is. using my favorite tool, which is Fibonacci extensions. Fibonacci theory, if you don't know the sequence, it's in like everything in the universe and the world. And there's a golden ratio, and there's two key levels that are very important. That is the 618 extension, meaning whatever this rally up to the upside was, 61.8% of that rally is very certain to hit. And then what happens is if we hit this 618 level and we have a bit of a pause in price, we almost always see price go to the 100% measured move. So based on this rally, we'll have that same rally afterwards. And that is pointing to about a 20% rally from where gold is right now. And that coincides perfectly with what happened in 2007. The stock market sells off. People think, things are falling apart, and everybody moves to physical assets. Gold is by far the best play, which if we go through silver and miners, why I don't like those versus physical gold right now. But that is the scenario that's unfolding in it. Even though this scenario, this market big correction that could be coming is going to be on something totally different than the 2008 crisis, the stock market and assets always do the same thing when something bad happens. They sell off. Fear is the same, whether it's a tech bubble crash or it's a financial banking crash, a real estate crash, or it's a tariff and whatever the new reason will be. Once we enter this scenario, it doesn't matter. We see prices do the same thing. Gold should become that favored play. Obviously silver is a much uglier chart. It's in an uptrend. It has a series of higher highs and higher lows. But just looking at the chart, it's pretty ugly compared to gold, which stair steps its way higher. If we take a look at the price of silver, of where it could potentially go, it did have quite a bit of damage done, but it is still pointing to the upside target of about $40.70 or 80 cents. So it has some upside, and it might blast past that if we do get this surge of people moving into physical metals, but it's a pretty ugly chart. There's a lot of damage done recently. Silver pricing, it kind of broke down on a short-term basis. If we look at the silver miners, they're not breaking out either. They've had a nice run, but they're not breaking out to new highs. And if we look at gold miners, like the large caps, which are my favorite ones to follow, when they break out before gold does, is a very bullish sign. So we're seeing big money move into gold miners, large caps. Typically gold will follow suit. So if you miss the breakout in gold miners, it's like, well, you have the second opportunity with gold about to break out and pop. And so, out of the two plays, gold or silver, gold's the one. And then large cap gold miners is my next kind of favorite
GDX.
Play. GDX is the symbol that I prefer. The thing is, we're in a market scenario where, venture capital money is hard to get. Everybody's nervous. Everybody's tight. Things are breaking down and not as strong as they should be. So big, smart money is kind of gravitating to where they think they can make money, but without sticking their neck out and taking a ton of risk. Gold is a big, slow pet rock. You can put a lot of money in it, and a couple big bad days in gold is not going to slaughter you. One or two bad days in silver or any of the miners will hurt really bad. So, and large cap gold miners move slower than the small caps. So that's why silver and the junior miners are a very difficult play right now, because big money is just saying, I don't want to take that risk. I know the precious metal space is favored. It's in favor to do well, but they're not willing to like swing for a home run. They're just like, I want to get into position myself smartly with kind of my risk managed a little bit. So they're going to the bigger slow cap gold miners and, gold, just because people are looking for protection, not so much grand slams right now.
Chris Vermeulen doesn't chase narratives. He focuses on one thing, the direction of prices. If it's moving in your favor, stay in. If not, get out. No guesswork, no emotion. It's a method built on discipline and anchored in price action, not headlines. At the core of his strategy are support and resistance zones, critical levels where the price either confirms or breaks your setup. If support fails, cut the position and move on. If it holds, the upside can be substantial. This allows Vermeulen to manage risk tightly and stay in trades that have real momentum. It's a strategy he applies across the board: gold, silver, commodities, and equities. Right now, he's especially cautious on equities. Vermeulen points to recent NASDAQ behavior that mirrors 2024's top, warning that we could be on the edge of a 15% correction, or worse. In his view, bear markets don't drag on slowly. They hit hard and fast, often erasing years of gains in a matter of months. His advice: have a clear plan before the volatility hits. Once the panic starts, it's too late to think. Vermeulen warns against going entirely defensive. Historically, 78% of the market's best days happen during bear markets or in the first 2 months of a new bull. Miss the top 10 days and your returns drop by half. Miss the top 30 and you're down 83%. His point is simple. Risk management is key, but so is staying engaged, because the most significant opportunities come when the fear is loudest. Let's get back to the interview.
I mean, the market has obviously, you and I talked way down here when it was putting in a bottom. We've had a bounce. It went from a dead cat bounce and turned into a very strong rally. We have pushed to new all-time highs on the S&P 500 and the NASDAQ. I do think the markets, as you were mentioning, the crowded trade, the Mag 7, have really dragged these two indices up to new all-time highs. The interesting angle here to look at is this these blended indices, which is the RSP, which is the equal weighted S&P 500. It's the small caps, the IWM, and the micro caps. So this is a view of the overall stock market of stocks in general. This is taking the weighting out of the heavy techs. And as you can see, the market has rallied up. We have not hit all-time highs. And so I still believe when you don't look at the Magnificent Seven driven indices like the S&P 500, the overall stock market isn't making all-time highs. It's struggling. Dividend stocks are struggling. Real estate stocks are struggling. Yeah. There's a lot of signs showing here that I think we're going to go back down and potentially test those lows. So that's where the markets are pointing to right now. And I think we need to just be aware that you have to have a game plan, whether it corrects and goes down there or not. We have to look at every pullback as if it could be the one that is a big correction. You never know if it's going to be a 3% pullback, a 15%, or a 50%, pullback that takes 10 years to recover. And that's what I focus on is through technical analysis. As soon as things roll over and they show us signs of weakness, we're like, all right, well, let's just get out of stocks. Let's move somewhere else that can make money as the stock market is out of favor. And that's kind of what we're entering as of you and I are speaking right now. We're moving out of the equities market. One of the plays here will be a discretionary play, get into gold, play physical gold to the upside through an ETF or physical gold itself. The other play is at this point, nothing else actually meets our criteria. So we move to a type of cash position and we just earn daily interest and a monthly dividend payment without any downside risk until something else sets up. Is the US dollar going to become a play, the US dollar index? There's an ETF we can benefit. It hasn't quite turned a corner yet for us to jump on board. Bonds are not favorable yet. They're still trying to base and find a bottom. So right now, the best spot is we're just sitting on our hands. We just had a really nice string of some big wins with our portfolio, and we're getting out right near what I think is a high. And we just have to sit on our hands and wait for the setup. And this is one thing that I think a lot of individuals don't understand is cash is a position. And sometimes it's the best position until there's a setup. You have to let the trades unfold and come to you. You don't go out hunting for trades, because if you go looking for trades, you're going to find them. Your brain will naturally be like, that one is good enough. After you look at like 50, you'll be like, I'll do this one. But really, there isn't a good setup. And if the stock market, from my trend analysis, if it turns red, which it has, if the stock market trend is going down, you don't want to hold any stocks. You shouldn't hold semiconductors. You shouldn't hold really any stock, because it moves like the ocean tide. When the stock market tide goes down, pretty much all stocks go down. That's one of the reasons why I like physical gold. Is not a stock. Gold miners are a stock stuck in a falling stock market. It's naturally going to have some pull on it to the downside. So why not just step outside of that sphere, get into physical gold or like a ETF that plays it or whatever, however you want to do it, and play that way. So that's my take. And I think Bitcoin, I do like the chart of Bitcoin, but the thing is, if the stock market heads down, it's going to pull Bitcoin down with it. Ever since Bitcoin became a futures and got really sucked into the stock market, more or less, that same money flow bubble, it starts to move obviously very close to the NASDAQ. Bitcoin is primed and ready for another pop and push up to about $135,000, $136,000. But what I like about Bitcoin is it is an explosive move when it runs, but it needs to prove itself. It's not favorable. The best play right now, I think, is gold or a cash position. Both of them are actually, gold's pretty exciting because there's a lot of upside. Cash is a pretty boring position, but it feels really, really good when the markets fall apart and everyone's losing money and it's all red on TV and everybody you talk to is losing money. You're like, well, I'm holding my value and I'm still making a little bit every day going up. So sometimes it's hard to sit on your hands, but it is actually a very good play right now. I think the next stop, if it rallies from here, is going to 135,000. But right now, it looks like it's in a short-term downtrend. The stock market just turned down, so it's probably going to go back down to probably 100K.
Chris Vermeulen strips market analysis down to its essentials, price action, trend, and momentum. No distractions from economic headlines or Fed speak, and right now, those charts are flashing big signals. Gold, in particular, is setting up for what he calls an explosive move. With large-cap miners in the GDX ETF already breaking out, these breakouts often lead to a breakout in gold itself. His near-term target? $4,100. That's not speculation, it's what the price structure is pointing to. Silver, on the other hand, doesn't have the same clarity. He sees short-term technical damage, especially in silver mining stocks and junior gold miners, where the charts still look broken. Until those clean up, he's sticking with physical gold and large producers. Momentum is brewing quietly beneath the surface. While silver tests its footing and mining stocks wobble, gold is charting a different course, steady, structured, and increasingly difficult to ignore. The divergence between physical demand and market pricing is widening rapidly. What was once seen as a hedge is starting to look like a frontrunner. Institutional players are already shifting their weight. If the broader public follows, repricing won't be gradual, it'll be sudden. Can traditional equities hold their ground when capital begins moving where conviction already lives? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.